We'll start with 14-22, where you're basically given some financial statements, and you're going to have to uh, basically use the financial statements because you're given the income statement, you're given the ending and beginning balances on the balance sheet, and some extra information. This is a warm up, okay? It's helping you to think about how to set up the things that you will need for the statement of cash flow. Remember, we talked about for plant assets, there's disposals and acquisitions. Um, so this will help you figure out the precursor to actually setting up the statement of cash flow. So I think just follow the directions. We'll just go in order of these requirements. We're gonna have to tie in various concepts to figure this out. Okay, this is why this chapter is especially challenging because you're bringing in stuff from previous chapters. It's really testing your understanding of what the balance sheet is saying. Let's go through this. Okay, so the first one, it's going to relate to plant assets and accumulated depreciation. So if I look on this balance sheet, I have my starting and ending balances for both of these. Okay, so I'm going to just fill that in first. Okay, so for plant assets, my starting balance is 219,600, and my ending balance is 265,200. Okay, so this is beginning balance, ending. Okay, and then for accumulated depreciation, beginning 36,600 and ending 44,200. This is again a credit balance, 36,600 and 44,200. Okay, the other thing I know that happened during this period for accumulated depreciation is if I look on the income statement, I have a depreciation expense of 52,000. So if I put 52,000 here, this is depreciation expense. It's clearly not right, okay? It's off because if I add these two up, it's not going to be 44,200. It's something much larger. So I know something is missing from there. So let's just continue on. So I've kind of filled in what we know based on the financial statements. We don't know exactly what happened with plant assets. We're going to now kind of read the rest of this and try to fill out the rest of it. Okay, so um, we know that there was a disposal of plant assets at book value. Okay, so uh, what is the book value? In the next line, it's telling us the cost and accumulated depreciation of the disposed assets was 44,400. So what is the book value? If both the cost basis and the accumulated depreciation is 44,400, it's zero, right? The cost basis is 44,400. Over the life of that asset, we fully depreciated it. We've taken a total of $44,200 of expense, and the total accumulated depreciation is exactly the same as our cost basis. So the book value is zero. Okay, so it's telling us that we sold it, we basically disposed of it for zero. So there's no cash related to this. Okay, so we do know though that we're getting rid of $44,200 of assets and also 44,400, right? Okay, so let's just make sure that this works. Yes, it works. Okay, so we now have kind of completed accumulated depreciation in plant assets. It now is reconciling our beginning and ending balance. We have this is related to disposal, and also this is related to disposal. Now, have we reconciled this plant asset? No, we haven't, because right now it's off. There's something missing on the debit side. Okay, so we can figure exactly what that is by just taking the ending balance minus the beginning balance plus this credit, 90,000. Okay, so now let's just make sure it works. This plus this minus this. Okay, let's see. Yes, it works. And what does this represent? These are our acquisitions. Now, it would be more complicated if we sold Our disposal was not just done at book value. We had like a gain. You'd have to figure out what that journal entry was, and then that would be how much you would have uh, cash inflow from disposal of assets. In this case, since we disposed of it at book value, which was zero, there was no cash that was transacted from disposal. So our statement of cash flow is only really going to have this acquisitions because there's no cash flow from disposals. We only had cash flow going out from acquisitions. Okay. So in future examples, we're going to see that, yeah, we have to actually figure out how much cash we brought in from the disposal because, there was some cash that we disposed of the asset from and we had some cash coming in. But figuring out how to populate this stuff, this is going to be like one of the challenging parts of this chapter. Okay, but I think it's not too bad. You guys know everything. You just now have to piece it together to kind of complete this. Notes payable, it's telling us that there's only one transaction during the period. Okay, having only one long-term notes payable transaction. That's what it says. So if we just simply look at our comparative balance sheet here, we can see that the notes payable went down. Okay, so we have the beginning balance, which is the 66,000, and then the ending balance, which is 59,000. So we basically have, again, 66,000, 59,000. This is our ending balance. This is our beginning balance. So then how do we get from beginning to end? What do we need to do? We must have had a credit, right? 7,000. So what is this? When we credit notes payable, what does that represent in in just kind of like actual business terms? What happened here? Yeah, you paid off some of your notes payable. So this is a what is the so this is the debit. What is the credit? What would have the credit been in the journal entry? Cash, right? So this represents a cash outflow. Okay, so this is a payment of notes payable. Okay, so uh, you just need to understand kind of what the second part of this is, right? And it's important because that's, it's part of the statement of cash flow. So a payment of notes payable is related to a cash outflow because it's a debit to notes payable, credit cash. Okay. So it's the same thing with this issuance of common stock. There's only also one common stock transaction. It's not like we were issuing stock and then buying some back. We just simply had one common stock transaction. So all you have to do is look at what happened to common stock. So you can see that our common stock no par value went up. It went from 34,000 to 47,000. So 34,000 to 47,000. So this is beginning, this is ending. So what do we do? How do we get there? Do we have to debit or credit the common stock? Okay, so we must have had a credit, and this is from buying back or issuing common stock. What is it when we credit common stock? What are we going to debit? Cash. Okay, so this is issuance of common stock. Again, this is like the first journal entry we ever learned. Issuance of common stock. And so this is going to represent a cash inflow, and it's going to be just like notes payable. It's a financing transaction. So this is all going to be in the section on financing cash flow. We're going to have an outflow of 7,000 from payment of notes payable, an inflow of 13,000 from issuance of common stock. Okay. And then finally, retained earnings. Okay. So we have retained earnings, ending balance 289,000, beginning 239,000. So let me just put this in here. Is that right? 239 and 289? 239 and 289. Okay. So is it just is there just some $50,000 something? What is this? We need a total credits $50,000. Is this dividends? Does that $50,000 represent dividends? What am I missing here? Okay, good. So first we need to add in net income. Okay, so where should I get that from? Income statement. So 110,000 is net income. Would that have been in retained earnings a debit or a credit of 110,000? It increases. So is that a credit or a debit to retained earnings? Credit. Okay, good. So this is net income. We need some kind of debit, okay? Because if we just had these two, we would be our balance would have been 349,000, but that's not right. Our ending balance we know is 289 because we have the balance sheet. Okay, so that means to figure this out again, we had this isn't a quiz. There's some missing debit. Okay, so how do we figure that out? Well, we can just do this minus this, 60,000. So if we do this 60,000, now let's just verify this plus this minus this. Yes. Okay, so what is this debit? What is this? Where is it coming from? Dividends, exactly. That's why I gave you the hint, the statement of retained earnings. Starting balance plus net income minus dividends equals ending balance. So we had three of those pieces of information. We had starting balance, ending balance, and net income. And we just used those three to solve for that missing variable, which is dividends. Okay, so this is also going to go in the section on financing, okay, because it's related to equity. Let's pretend we had a net loss. Well, let's say, yeah, it was 110,000, 10,000. Let's just say that, okay. um, then you would have this debit. This is from a net loss. And then to figure out what the dividend was, you basically have this plus this minus this, 139,000. And then just to verify, this minus this minus this. Yeah, so this should be 119. And so this would have been your dividend. So yeah, I mean, you basically have to use this skill of, well, first you have to use the background knowledge of where does net income or net loss go? Is that a debit or a credit to retained earnings? And then you have to use the skill of solving for some missing debit or credit. And the reason why I needed to change this number is because this could not have been 289,000 because both dividend and net loss are both debit. So it would have been impossible to increase retained earnings. That's why I had to kind of alter the numbers. So really, this is like this kind of nuts and bolts, like understanding T accounts, understanding debits and credits. And yes, we've like gone a long way and built up a lot of things, but really this information, this framework was presented in chapter 4 or something. Okay, so if hopefully you still remember this. This is actually the important thing, understanding what is retained earnings, what are the components of it. I'm trying to emphasize that even just remembering that is important. All the details of, whatever, all the extra minute calculations we've done is not as important as understanding what these things are, in my opinion. Okay, so hopefully you do. And it looks like a lot of you do. Okay, but if not, you'll have to just go back and review.